Hey, girl.
Mortgage 101. Hi, Ashley. How are you?
Good, good. I'm glad to be here.
Good. Well, I just want to take a second. My name is Jill Franks for our viewers and those of you who I've not gotten to meet yet. And I am the marketing director here at Farmers State Bank. And I'm so excited to introduce Ashley McVicker for her first live video with us.
Yes. I'm very excited. I'm the new assistant marketing director here at Farmers State Bank. And this is my first Mortgage 101 with John, Streuter, and Jill. And so I am just thrilled because I'm about to learn a lot too. But if you are viewing with us right now, we want you to comment, ask questions. We kind of already have a few mapped out just to guide us along. But we would love for you to comment some questions, and we are absolutely here to help you and answer those for you.
Yeah. And we're excited to talk about FHA loans today. And I think this is probably the one product I know the least about is the FHA loan that we carry here at our bank. So John Streuter is going to be joining us in just a second. I'm excited to introduce John because he is just a wealth of knowledge when it comes to the mortgage industry. He's actually been in the mortgage world for 36 years.
36 years.
I know. And he has been with Farmers State Bank for just about 4 years. So he joined us in 2017. I think it was the fall of 2017. And what he has done for the bank, I'm telling you, he has grown the mortgage department like crazy. So without further ado, I just want to bring John on. See if we can pull him up here. Hey, John.
Hello. Hi, Jill. Hi, Ashley. How are you guys today?
We are great. How are you?
I'm doing wonderful. Staying busy.
Well, John, we're excited to have you today, and thank you for your time. I know you're super busy with all that you have going on right now for the month of May. I know real estate is crazy right now, especially in the springtime.
Very strong right now, but happy to do it. I enjoy informing people out there about what's available and letting them know that Farmers is here to not only take care of mortgages, but teach people about mortgages and what their best options are.
Definitely. John, before we get started, do you want to just, I've shared a little bit about how long you've been with Farmers and a little bit about your history, but will you give us just a little bit of down low on your history in the mortgage department?
Sure. I've been in the mortgage business for 36 years, started on the collection side and then became a mortgage lender, and then been a sales manager for a couple of different institutions, and then joined Farmers in 2017 to be the executive vice president, chief mortgage officer, to take over the mortgage operations and bring us to new heights. And we were just reporting to our board not too long ago that the first year I was here, full year, was 2018. And we did $37 million in closed mortgage business. And we took that in 2020 to $103 million in closed business. Wow. So we tripled our business in 2 years. And then so far, from January to April, we've already closed $30 million. So just in these first 4 months, we closed just shy of what we closed the entire year in 2018. So we've taken Farmers from being about 4th or 5th and sometimes 6th place in the mortgage business to in 2019 we were first in Williamson County, but not in other counties. In 2020 we were first when you look at Williamson, Johnson, and Saline County collectively. But we were first in Williamson County, we were first in Johnson County, we were second in Saline County. So we've taken Farmers to new heights, and it's all a team effort. We've got great people in our operations. I've got great mortgage lenders under me, so it all takes a team effort. And we've got great marketing people. You guys have done a great job marketing us, and that getting the word out is big.
We are happy to do it, John. And you've had what, 4 mortgage officers besides yourself, and it's been those same 4 throughout most of the time you've been here.
Right.
Yeah, we've got a
very strong mortgage team that knows how to get the job done. When it comes to government loans, we've kind of tagged me as the expert, and so government loans like the FHA loan will filter through me as the government specialist. But any one of our lenders will take applications and know enough to get the process done. And we close them quickly. We don't sit around on our hands. We, everybody's complaining about how long it takes to get a mortgage done. Our purchases are closing on average in 40 to 45 days. On conventional loans, on government loans, we're closing probably on average 50 to 55 days. Refinances, we're closing right at the 60-day mark.
Wow, that's incredible. Really
we hope to improve that, but with as much business that's going on, those are pretty normal and pretty good turn times.
Well, when I hear 45 days, I feel like that's pretty quick. So
it's to the consumer, it seems awful slow, but in our line of work, it's right now it's taken 4 weeks to get an appraiser to get an appraisal to us. So
yeah. Well, I don't want to take up too much time talking about this. Sure. I want to talk about FHA loans, and I think
absolutely.
I am clueless. Like I said earlier, this is the loan I know the least about. So why don't you tell us a little bit? Let's talk about what an FHA loan is and what's
sure. FHA loan, in brief, is one of the 3 government loans, federal government loans. So you have VA, which is exclusive to veterans. You have USDA, which is through the Department of Agriculture. You have FHA, that's through the Federal Housing Administration. That's what FHA stands for, Federal Housing Administration. This is the oldest of the loan programs. It started in 1934 as part of the programs that FDR started to help. A lot of banks, obviously, in the 30s crashed and savings institutions crashed. So FHA was to back up and give a federal guarantee to these loan programs to get everybody back into doing mortgage financing. So that's kind of the basis for an FHA loan.
Okay. Well, as a consumer, why would I want to use an FHA loan?
So the benefit of an FHA loan with conventional loans, a bank is going, what we call a conventional mortgage is your standard 15, 20-year, 30-year fixed rate mortgage. We're going to want a 20 or at least a 5% down payment, and not everybody's going to have considerable down payment money. So FHA is very good for first-time home buyers who are looking for a very low down payment program. USDA can be a program for them, but USDA has some income limitations and some limitations on where you can lend on USDA. FHA doesn't have those barriers. So FHA, you can make $10,000 a year or $100,000 or $200,000 a year and still qualify for an FHA program with only a 3.5% down payment. So we find college students that graduate a year into their employment are ready to buy a home. They will often turn to FHA because they haven't saved enough money for a down payment. They've been spending it on college expenses and tuition and student loans.
Ramen noodles.
Yep, ramen noodle, yep. And then the other person that will benefit greatly from an FHA is if you have less than perfect credit. Typically, for a conventional loan, a bank wants to see a 660 or higher credit score, whereas with FHA, we'll go as low as 620 credit score. So if you've had some dings to your credit and you're not sure that you could qualify, FHA is a very good option for people. The other thing is, because it's backed by the federal government, it does tend to have lower interest rates than conventional loans. So we always look at, when I work with a borrower that only has, say, 5% down, I'll look at, are they better off putting 5% down on a conventional loan, or are they better off putting 3.5% down on an FHA loan? And I'll do a cost comparison analysis for them to see which is the best option for them.
That's awesome. So are FHA loans easy to obtain, John?
Well, in my opinion, they're not hard to obtain, but with borrowers, most borrowers get the idea that they're difficult to obtain. Because it's a loan backed by the federal government does have a lot of requirements for FHA loans. So the key for a borrower is to make sure that you go to a lender like myself, Farmers, that knows all the requirements for an FHA loan and gives you a list of what documents we need, what the requirements are. Many times people will qualify credit-wise and income, but then they go find a house that won't qualify, and we'll cover those requirements here in a later question. So it is probably more difficult to qualify for an FHA than it is a conventional loan. So if you have 10% down, FHA is generally not the direction I lead somebody unless they have a really low credit score. But it's not absolutely difficult to where you have to be scared of it. It's just like anything, the more difficult it is, you want an expert who's going to be handling that. You know, you don't want a brain surgeon who's doing surgery for the first year in their life.
Yeah.
But somebody who's got 30 years worth of experience, you can trust that they probably know what they're doing.
Right.
So just to kind of reiterate, you said a credit score for an FHA loan, you would say anything 620 and above? You said that
we can go to a 620 credit score.
Okay.
There are probably some options out there for borrowers who are below 620. FHA does not have a specific guideline. Other than they say it has to be above 550, so I guess FHA has a 550 minimum credit score. But what you'll find is lenders will typically have a minimum credit score because that's where they view their risk relationship. Because even though it's backed by the federal government, we still have to do the collections on it. We still have to do the calling. We still have to maintain the escrow accounts. And so lenders will have their own bar for what is their minimum credit score.
I just want to say something that I thought was interesting. Like I said, I don't know a lot about mortgages, but how you said it's good for people freshly out of college or anybody that they can have an income of $10,000 a year up to $200,000 a year and qualify for this loan. So.
Yeah, with USDA is another program, and we'll save that for another subject on another month. But USDA has some income qualifiers. You have to be below a certain income to qualify for USDA. FHA doesn't have that limitation, so there's no income limit for an FHA borrower. So a good example is somebody who's an attorney, a doctor, somebody in a profession where they're just out of college and now they're going to be making $100,000 or $150,000 a year their first year through contract, but they haven't had a chance to save money because of all the money that they spent on school. We find that type of buyer for FHA quite often.
So FHA loans are not just for first-time home buyers, correct?
Correct. You do not have to be a first-time home buyer. So there's a difference between when we say they're good for first-time home buyers and when they're limited to first-time home buyers. So it's not limited to a first-time home buyer. So you can have sold your home as an example and have less than that 660 credit score and need FHA to be able to buy your second home.
Okay. So if I say in my position right now, it's not just for low income borrowers either, correct? So
correct. That's why I said we find a lot of high income people that look to FHA because they just haven't saved in the professions that I mentioned, attorneys, and doctors, people that have, unfortunately, because of the economy the way it is, they've racked up a lot of expense in student loans. And so they're trying to get those student loans paid off. And so they haven't saved a lot of money. But yet their income is above those income limits for USDA, and they can put together a 3.5% down payment. Now, also, I'll mention, this may have been one of the questions that comes up, but I'll just mention it now, that down payment does not have to be, that's another benefit with FHA, that down payment does not have to be your own money. That can be a gift from a family member. We don't have any programs right now in our market, but for anybody that's out there that may be in a metropolitan market, there are some nonprofit organizations that make available grants for down payment money, and you can, as long as that grant doesn't have to be repaid, FHA will allow that to be a down payment. But currently we don't have any grant programs available in our market for that.
I've got a good question, and I bet a lot of people are probably wondering this. How would I be turned down for an FHA loan?
So there's a couple of primary things that you want to look at. One is, for us, that you need to have that 620 credit score. But people are using Credit Karma and some of these third-party agencies for their credit tracking, so that they may have a Credit Karma score of 650. They need to realize that those aren't credit scores from one of the three bureaus, Experian, TransUnion, and Equifax. So those third-party companies develop their own scoring model. They unfortunately use a scoring model that is not as strict as what we use for mortgage financing. So there are different levels of scoring. So if you just pull your own credit, that's going to typically give you the highest credit scoring model. If a car dealer pulls your credit, that's a different scoring model. And then when we pull for mortgage, because Fannie Mae and Freddie Mac require very strict requirements on credit scoring, that's going to be the lowest score. So we often see the score we pull as much as 50 to 100 points lower than that Credit Karma score.
Wow.
So say them again, John. What are the three places?
Equifax, Experian, and TransUnion are the three credit bureaus that actually do all the scoring. Okay. If you get your information from anybody else, you're using a third-party vendor that you've given permission to tie into your credit, and then they use their own scoring. And Credit Karma is the one that we hear the most. They say that they're free, and what people need to understand is, because they're a third-party agency, you're allowing them to sell your information, and that's how they can't sell private information. But let's say I have a Credit Karma account and I'm tracking my credit score and it's above 740. Somebody out there can say, I want a list of everybody that's in your tracking system that has credit scores of 740 or higher. Right. And then they're going to give them that list, and then I'll get pre-qualified for a credit card and solicited for a credit card. Mm-hmm. But the other thing that people need to realize, and I know this is kind of off the subject, but it's a good subject, with those third-party agencies, they aren't controlled the way the credit bureaus are as far as security purposes, and they don't have to answer to the federal government. So your information could be tapped into and hacked a lot easier through somebody like Credit Karma than you can through. So I generally try to recommend people, if you're using Credit Karma, get off of it. Pay the fee to have your credit tracked through one of the three credit bureaus. Even then, your information can be used for pre-qualifying with credit card companies. but there's a lot more security measures whenever you use the 3 credit bureaus rather than one of these third-party agencies.
Man,
So more security, more accurate. Okay.
So it's getting back to that original question. So too low of a credit score. So for us, if your credit score is below 620, that would be a turn down. If the property doesn't qualify for the conditions for FHA. So with FHA, your property has to be pretty much move-in condition. They're not interested in doing a high loan to value with very low money on a house that needs all kinds of improvements. So they don't want their borrowers looking for fixer-uppers or
That's what I was going to say.
Homes that need tender loving care, all the acronyms that you see when you look at real estate. You know, if you see an acronym, TLC or needs a little love or just needs a few repairs, those are probably not going to qualify for an FHA loan. FHA doesn't have to be in perfect, spotless condition, but functionally, it's got to be in good condition. All the appliances have to be in and working. Plumbing has to be up to code. Electrical has to be up to code. One thing that people don't realize is the roof generally needs to appear to have a 5-year or more life expectancy. So the appraiser is the one who makes those judgment calls for us. And so the appraiser is going to take a visual snapshot of the roof and say, you know, if it's got 3 sets of shingles on it and it looks pretty worn, the appraiser is going to probably say that there's a problem with our roof and may require that to be replaced in order to qualify for FHA loan.
Now,
another thing that we see on FHA that a lot of people don't realize is if there's 2 or more steps, there has to be a handrail, whether it's outside or inside. There can be 1 step, like a porch step, but if there's 2 steps or more, there has to be a handrail. And that's where we probably see the biggest problems with appraisals is when there's steps and there's no handrails. Another thing that people want to look for is there needs to be GFCI outlets in the kitchen, the bathrooms, outside, and in the garage. That's another requirement with FHA that people don't realize.
Wow. So the appraiser comes in and looks at all of these things on every single house that you would be interested in.
Correct. FHA requires that you use an FHA certified appraiser. So not every appraiser is FHA certified. They have to go through a little bit of a questionnaire when they get licensed with FHA, that their FHA has a handbook, and they basically have to say, I've read and understand the handbook, and then they use that handbook as their guide for if the property qualifies. And they'll have a check sheet. Every appraiser has their own check sheet when it comes to an FHA loan to say, do we have GFI outlets everywhere? Does the roof appear to be in okay condition? Heating and air needs to have some life expectancy to it. They can't be on their last leg. The appliances all have to be in the home and they all have to be working. So some people have a dishwasher that doesn't work, and so they'll take it and get rid of it and just say, well, I'm selling the house, I'm not going to replace it. With FHA, you'd be required to put a dishwasher in there. So it doesn't have to work well, but it does have to work. And like I said, heating or plumbing and electrical all have to be up to code. So that's another thing that the appraiser will look for.
So since there is that appraisal process, and does it take a little longer to close?
It can because the appraiser is going to take a little bit longer to do that appraisal. They're going to take longer to view the home. They may even make some remarks and go back to their office and review the handbook to make sure that this, and if there are anything that's noted that has to be done, we have to go to the buyer and seller and say, these have to be done. Now, often buyers think that this is a checklist for the seller to say, seller, you've got to correct this. And that's actually misinformation. The appraiser is saying to qualify for an FHA loan, these things have to be done. But you're back to a negotiation process with your seller as to, is the seller going to cover these items, or is the seller going to cover these items but going to raise the price because they know that they're having to spend some money to get this to meet for a loan for your program? Or in some cases, buyer and seller split the cost, and the buyer pays for their portion at closing time as a credit back to the seller. So buyers need to understand that's really a thing that you have to go back and negotiate. It's just not a laundry list for the seller to say, you got to take care of this, this, and this. So people say, well, do I need a home inspection? We still recommend a home inspection because this is just a cursory look at, here's what FHA requires an appraiser to check off. Appraisers aren't home inspectors, so they're not certifying that you won't have an electrical problem. They're not certifying that you won't have a plumbing problem. They're not foundation experts, and so they're basically going through and just turning on and off switches to say, yes, this stuff works. Mm-hmm. We still recommend for borrowers to get that initial home inspection. And one thing that I can do, and that we'll do at Farmers, if you get that home inspection, before we send the appraiser out, we'll be happy to look at the inspection and say, okay, here are the things that we know you're going to need to have fixed before we send the appraiser out. Otherwise, the appraiser has to make 2 trips. They're going to do the initial inspection. They're going to say these things need to be done. And then they have to go back out and verify that those things have been done. So that's going to be additional cost to the homeowner. So we always recommend, let us take a look at your home inspection and see if there are issues that we feel the appraiser is going to require.
So John, what if the appraisal is below the sale price? What happens then? Sure.
That encompasses a whole lot of answers, but we're going to direct it to FHA only today. FHA has a clause that the seller, an amendment to the contract that the seller and buyer have to sign, that says the appraisal has to come in for the equal value of the purchase price or greater, or the seller has to allow the buyer out of the contract. Either they have to renegotiate it, or they have to let the buyer out of the contract. FHA will, there a little bit of leeway now, but used to FHA prohibited a borrower from paying the difference. FHA will now allow the borrower to pay a little bit of a difference as long as we can show that they have funds to do so, and that those funds won't put them in a financial strain. So I'll say as an example, let's say the appraisal comes in $1,000 less, and the buyer says, well, I'm happy to pay that $1,000. As long as the buyer can show that they've got their 3.5% down payment plus that $1,000 doesn't totally wipe out their savings and checking account, we can generally get that approved through FHA. But FHA, let's say the difference is $5,000 and the borrower says, well, I can borrow that money. FHA will not allow them to borrow that money to make up that difference. Or they say, I have $5,000 in my bank account, but it's going to break me to zero. Then that clause amendment comes into play where they have to either renegotiate or let them out of the contract. But typically you don't want to pay for a house. You know, I tell borrowers, why would you want to pay for a house more than what it appraises for? Right. It's like going into Walmart and saying that, well, it's worth $50, but I'll pay you $60 for that item because I want it that badly. Maybe people do want something that badly, but.
I have a question for you, John. So it sounds like there's a lot of different people in this process with an FHA loan. So it's not like a typical process, right? So correct. What is the timeline So who should I meet with first? What is the time? Like, when should I be meeting with who? When should I get an inspection? When should I, what does that look like?
Your basic timeline is, if you think that, basic timeline is any time that you're looking to buy a home, we recommend that you get pre-qualified and talk to your lender. Hopefully it's Farmers, and come see me or any one of our great mortgage lenders. Talk to them about all the products that you qualify for. So you may think, well, I've got 5% down. Ask them, are there other products that I qualify for? So I'll generally go through a borrower and say, okay, you qualify for X, Y, and Z. I'm recommending that we probably go with Y, but we still have X and Z as an option if for some reason when you find the home, Y doesn't work out. So let's say I say FHA is probably your best bet, but you do have 5% down. And then they find a home that does have a few issues, then I can say, well, that's not going to qualify for FHA, but we pre-qualified you on conventional as well. So you always want to get what kind of loan program you can qualify for, and know that you can qualify for more than just a specific program. Then you want to meet with your real estate agent and start viewing homes. Once you start seeing homes in that price range that you're qualified for, you can see, are these homes going to fit with FHA? Call your lender again, your loan officer, and say, these are the kind of homes that I'm finding. Will these qualify for the FHA loan program, or will I have to go a different direction? Once you make the offer, then your agent and banker will communicate and get the everything situated, get disclosures sent out. At that point, you want to get your home inspection and your pest inspection done. FHA does require for you to have a pest inspection on the property. And once you have those inspections done, you want to get those inspections to your lender so that they can review and see if there are any issues related there.
Is a pest inspection required for conventional loans, or is that?
They are not, but they are required for government loans. But in Southern Illinois, I tell everybody, get a pest inspection. We are in one of the high areas for termite activity. Our climate is very high for termite activity, and I can tell you in 36 years, every time that somebody said that, well, I'm going to pass on that pest inspection, they have come back to me within 4 to 6 months and said, guess what? I've got termites. And I know it's crazy. I don't know why, but I just tell people, every time somebody's passed on the pest inspection, they have come back to me later and say, you told me not to pass, and I did, and I've got termites. Now, there are some people who have family members that may work for Terminex or something like that, and they don't have an official inspection, but they have a family member that knows how to look for termites, and I still call that a pest inspection, even though it's not an official pest inspection. But,
okay. Thanks, John. Sorry to interrupt you. Yeah.
Unfortunately, home inspectors don't check for, they're not licensed to check for termites and other pests, so they won't give you a pest inspection.
Interesting.
From there, after the inspections are done, you'll get into the appraisal situation. The appraisal will often take about 2 to 3 weeks on an FHA loan. The lender may or may not wait to order title work. That could take another week or two. You generally then have to ship the file to an FHA underwriter, and they go through the process, and they may have some additional conditions based on paperwork that they didn't receive. And that's where it's real critical to be working with a lender that knows what they're doing on an FHA loan. Because I'll hear from people and they say, well, I send something in and then they want something else. You send something in and want something else. You want to get a full package sent. And then when the conditions are given to the lender, you want a lender that communicates all those conditions. And you want to get all that information back to the lender all in one piece. You don't want to if we ask for 2 pay stubs, don't give us just one. If we ask for 2 bank statements, don't give us just one. That's the time frame that continues to make things take too long when you get items just pieced together and you don't get everything put all together. Or a lender who's only really done conventional loans and decides all of a second, well, I want an FHA loan, and the lender doesn't realize all the other information that we need for an FHA loan.
John, can an FHA loan be refinanced?
Absolutely. FHA actually has a streamlined process. So if you currently have an FHA loan, you can go to that same lender. And then in some cases, you can even go to another FHA lender if you don't like the lender you're with. You can do a streamlined refinance, which will allow you to avoid an appraisal. We just have to update title work. And that's generally for, like last year when people were wanting to lower their interest rates, and that's all they wanted to do. You could do an FHA streamlined refinance. If you're needing to borrow additional money, and maybe you need FHA because of your credit score, you can do a refinance with a FHA loan and get cash out. Or you may have an FHA loan and you haven't established enough equity in the property, and so you may still need an FHA loan. You can refinance those for a lower interest rate. So if you're just needing rate only, we'll typically look and see if we can qualify you on a streamlined process. If you're needing additional cash out or you're needing to pay off some debt and consolidated debt, that'll be a full refinance.
Awesome, John. Since we're talking about refinancing and interest rates, how are FHA rates determined?
The whole rate market is determined by the bond market. The driving force behind mortgage rates is the 10-year Treasury bond. And so investors, all mortgages are sold on the secondary market. Conventional loans are sold to Freddie Mac and Fannie Mae, which are quasi-government groups. They get money through the federal government and through selling their loans as a security. Government loans like FHA, VA, and USDA are sold to a group called Ginnie Mae. So they set the base rate, and then a lender adds to that what they need to make. So an FHA is not going to be a flat rate established by the federal government. Ginnie Mae establishes the rates that they want on an FHA loan, and then each lender is going to add to that whatever they feel is the amount that they need to make on the loan. So, but because they're government guaranteed, even though they're a lot higher loan to value, they're government guaranteed. So investors are always looking for anything that has a government guarantee, and so investors are willing to take a lower rate on things that are backed by the federal government. So that's why your FHA loan tends to be the lowest rate out in the marketplace, because it has that federal guarantee behind it.
Great. So do they offer adjustable rate mortgages or just the fixed?
They do. With FHA, you can get a 30-year fixed rate, you can get a 15-year fixed rate, and you can get a 1-year adjustable. Right now, there's not real benefit to doing adjustable rates because the rate isn't low enough to make, in my opinion, to make it worthwhile for you to take the risk. But at some point in time, we may see rates move up. So as an example, when I got my first loan back in 1990, I took a 30-year fixed rate FHA loan at 10.125. I could have taken much higher rate than today. But at that same time, I could have taken an adjustable rate that would have been around 8.5, 8.75, I think. I chose to go the fixed rate basis. But when you can get an adjustable rate that is 1% or more below the fixed rate, that's when it's probably time to consider an adjustable rate. But otherwise, right now, the fixed rates are still the lowest option out there.
So, John, why do they require mortgage insurance?
So mortgage insurance is what helps the government back that loan. So if you default on the loan and a bank has to foreclose, we're going to sell that house. And generally, because it's what we call fire sale conditions, it's you're trying to liquidate it, you're generally going to end up taking less for the home, or maybe the home's not in as good as condition anymore. It wasn't well taken care of. So many times you're going to take less for that property than what is owed on the loan. So the insurance, like anything, is to help recover a loss. So the federal government still calls, in the conventional world, we call it PMI, private mortgage insurance, because we use a private company to buy mortgage insurance to insure that. We're insuring that difference between 100% financing and 80% financing. So with FHA, the government just calls it mortgage insurance, or they call it mortgage insurance premium, MIP. What they do with FHA loans, and this is where you always want to do a cost comparison, because FHA charges an upfront fee of 1.75%. So on a $100,000 loan, you're looking at an upfront fee to the federal government of $1,750. Now they will finance that into the loan. So your loan starts at 101,750 at that point, and then minus your 3.5% down payment. They also then charge a monthly premium for the duration of that loan, because you're going to be paying that monthly insurance helps go into what they call a pool. A pool is just where all that money is pooled into. And then whenever there's a loss, FHA will buy that loan from the bank. They will pay the loan off because it's guaranteed. FHA will sell, or HUD will sell that house. And if there was $100,000 owed and they only sold it for $85,000, they're going to dip into that insurance pool for $15,000 to make HUD whole at that point in time. Okay. So that's how mortgage insurance works. You're paying to insure the down payment rather than putting up the down payment.
Okay. Yeah. And that's different from conventional. Conventional
doesn't have an upfront fee. They just have a monthly fee. And the monthly fee is based on whether it's a 5%, 10%, or 15% down loan. It's also based on your credit score. So there's numerous factors that go into private mortgage insurance, or PMI. It can be anywhere as low as 0.2% on a loan to as much as 1.5% on a loan, and then divided over a monthly basis. Whereas FHA is 1.75 automatically and 0.85 every month automatically. So FHA has the costliest mortgage insurance, because they are guaranteeing and lending to borrowers with lower quality. So it's like car insurance. If you've got good credit, you're unfortunately helping to pay for those that have bad credit for FHA to be out there guaranteeing these loans. So if you have a credit score above 660 and you have 5% down, I'm generally going to say you're probably going to be better off with a conventional loan and going with conventional PMI insurance. If your credit score is below 660, then you're generally going to be better off going with FHA. But again, you always want to have a lender that's going to do that cost analysis for you to make sure.
Awesome. So is that for the entire life of that FHA loan, or? For
an FHA loan, it is. You have to refinance in order to get out of FHA insurance. With a conventional loan, you're only paying it till you get to 80%, and then it gets dropped off at that time.
My goodness. I'm trying to think. Ashley, do you have any more questions for John? I feel like I know so much now.
I know, John, you told me that there's no dumb questions, but I'm just trying to think. I'm 23, so I'm just trying to think from this standpoint. I just don't know. Can you say I started out with an FHA loan, could I somehow switch to
You can.
a commercial loan? Is that
It
a
is.
possibility? And why,
Yes, and
why would somebody
people
want
do it all people do it all the time.
to? Okay, so those are dumb questions.
Basically, you'll have, when you have 5% more equity in the property and interest rates have gone down, then that's a good opportunity to get out of your FHA loan into a conventional loan. So last year during the big refi boom, we had a lot of people that moved from FHA to a conventional loan because their credit scores were good. They had 10% or more equity in their home, and it was more advantageous to take a conventional loan at that point in time. Now, some people still did the streamlined refinance. I hope their lender took the opportunity to make a cost comparison to say, okay, is it still reasonable to pay that mortgage insurance premium as opposed to going into a conventional loan? If you have 20% equity, you definitely want to refinance out of the FHA loan into a conventional loan.
Okay.
Even if you're only going to save a little bit on the interest rate, you're going to save a lot on that FHA premium.
Okay, so we can switch, people. We can
Yes.
switch. Okay.
That's good.
Good to know.
And I kind of made myself a cheat sheet on what the condition requirements are for an FHA loan. So I'll just reiterate those since we're specifically talking about FHA, because these are the big items that the appraiser will look for. Again, needs to be in move-in ready condition. Everything needs to be complete. There can't be any flooring undone. There can't be any walls that need to be replaced. Can't be a bathroom in the middle of being repaired. Appliances need to be present and operating. So you need your stove and your refrigerator and your if the house is wired and has a spot in the cabinetry for a dishwasher is not required for an FHA loan unless there's a spot in the cabinetry for it, then it needs to be there. Roof life expectancy typically needs to be 5 years or more. You know, it may be 4 years, who knows, but the appraiser is looking at, are they going to have an immediate expense to repair or replace the roof? Can't be any water spots on your ceilings, because that's going to be an indication that there's a leak in the roof. Electrical and plumbing all have to be up to code. GFCI outlets in kitchen, bathroom. And the big thing is garage and outdoors. Not all programs, many programs will require you to have GFCI outlets in the kitchen and bathroom. FHA goes a little bit further and says they've got to be in the outdoor and in the bathroom, or in the garage, I mean, because there's outdoor water sources in that situation. Handrail on 2 steps or more. Some people will say, well, it goes downstairs and I've got a wall on both sides. Unfortunately, they don't look at that as being a safety situation. So you've got to have at least one handrail on the left or right-hand side. This is another catch that we have to send appraisers back often, is the water heater has to be attached to a wall. It has to be secured. So plumbers know what this requirement is. It's some straps that you have to put around the top of the water heater and the bottom of the water heater, and then those straps have to be bolted into a secured wall at that point in time. And there has to be an overflow valve on your water heater or a drain tube, a drain tube attached to the overflow valve. Many water heaters don't have this, and that's another safety requirement, so that water doesn't flow everywhere if the safety valve goes off. Any lead-based paint has to be removed. So if there's flaking paint and the house was built before 1978, all that paint, flaking paint, has to be removed on the assumption that it might be lead-based paint. That's another item that catches us often. And then no exposed wiring. So if somebody took the chandelier out and said, well, that's a chandelier that's been passed from generation to generation, well, you've got to put a light fixture up there. There has to be, there can't be any loose wiring. Now, this is a requirement for all loans, but again, I want to reiterate with FHA, you got to have a smoke detector on each floor of the home, and you have to have a carbon monoxide detector on each floor of the home and within any sleeping space. And people say, well, I don't have any gas in my house. If you have an attached garage, it requires a carbon monoxide detector. So when you're preparing your home for sale so that it can meet FHA guidelines, you'll want to go down that checklist and say, do I meet all those guidelines so that if my buyer wants an FHA loan, we're not going to have any problems getting an FHA loan.
Right. That was something I was looking into too. The fire detector or the smoke detector and the carbon monoxide. A lot of people think that they're built in, and a lot of the new ones are built in. A lot of confusion comes from it's better to have them separate, I heard, because if the smoke detector goes off and it's the carbon monoxide, you might see or not see a fire or see smoke, but it's the carbon monoxide. So actually getting them separate, I've heard, is a better option. So.
I was just going to say really fast, I think it's interesting for sellers right now to really hone in and listen to this stuff, because I was thinking about how this all connects, buying and selling. It's good for people that are selling their houses to make sure, okay, if I do get an FHA loan, someone wanting to buy my house, I really do need to make sure I have all of this stuff ready to go.
And if we have any real estate, if we have any real estate agents listening out there or catch this at a later time, I will sit down with real estate. When I go to real estate offices, I tell them when you're listing a house with somebody, the best thing that you can do is go down that short checklist that I gave you and make sure all those things are done in the house. And then you can put on there, this home qualifies for government financing. And that way, when a first-time home buyer looks at the home, they say, well, they've already done all these things. I don't have anything to worry about. It's amazing how many sellers aren't willing to do that whole list of items that I gave, except if the roof was needing replaced. All those other items you could get fixed for $100 or less. And
a handyman can do all that.
Right.
Not sure.
And people just don't do it. You could have all those things done with the exception of the roof for $100 or less, and then say your house will meet conditions for FHA, VA, or USDA, because FHA is the strongest of the three. The other two require some of those same conditions. VA is not as big about the handrail situation and things of that nature. So if you meet it to FHA code, you're going to meet all the different code requirements.
Great.
Good deal.
John, if there is one thing, wrapping up here, that you would want people to know about FHA loans as we close this webinar, what would be the one thing you'd leave with?
I think the one thing that I would like people to remember is that FHA is not always the best product. Many people will they need to understand when they use Quicken or any of these online agencies, they are automatically going to qualify you for an FHA loan because that is where they make the most money. They are all commission salespeople, and they get paid the most money by generating an FHA loan. So when you go to a non-community bank, you go to one of these mortgage brokers, they're almost 90% of the time going to fit you to a FHA loan, and that may not be the best situation. If you have 15% down, they're still going to put you in an FHA loan, and if you've got a 740 credit score, you're probably better off going conventional. So I recommend for people to come see us at Farmers, because we're going to sit down and find out, is that the best product? And not all lenders have those government loan programs. So you want to ask before you get pre-qualified with somebody, do you offer conventional and government loan programs? If the answer is no, you probably want to get pre-qualified with somebody like Farmers and come to Farmers and get pre-qualified, So you know what programs that you're going to qualify for, whether FHA is your better program or whether conventional is your better program. What's the FHA rate compared to the conventional loan rate? Many times these online lenders like Quicken, they're going to charge a huge origination fee and large closing costs. So they may say a rate that's a little bit cheaper than what your community bank quoted, but then they get to closing and find out that they've got all these closing fees that they didn't realize. Community banks like us don't try to give you smoke and mirrors with interest rates. We know that most borrowers here don't want to pay large points or origination fees. So we're generally going to quote a rate that has the lowest fees. If you want a cheaper interest rate, by all means, we can generally find you a cheaper interest rate. And then there's going to be some upfront fees that you have to pay with that, what we call points. So that's the biggest thing I would tell people is don't think that FHA is the be all of end all for mortgage loans. Use your community bank like Farmers to get pre-qualified to see which is going to be the best loan program for you.
Awesome. John, thank you so much for your time today. I feel so much more knowledgeable when it comes to talking about FHA loans, if someone were to ask me about them. So thank you so much. But in closing, I would just, where do people reach, or where can people find you? If you're doing this in the future, how can people contact you?
We have a number of options. Obviously, you can call us, and the phone number is listed there on the screen. 528-1188 is my cell phone number, and that's a bank cell phone number, so you can contact me there anytime. My email address is listed there. You can always contact me by email, and you can go to our website, myfsb.com. You can apply online, and that also has a section there where you can do an inquiry about loans, and that inquiry will get sent to us to get answered. So you can communicate to us through that website as well.
Awesome.
Thank
and
you.
you can always walk in. We are fully open now.
That's great.
And we're following all the requirements. Many of us are vaccinated, so you can go mask free, and feel free to walk in and see us anytime as well.
Absolutely. Well, thanks again, John. It was great to see you, and
you're welcome
for sharing your knowledge.
I was glad to be here, and look forward to our next session next month.
Amazing.
Yes, I'm excited. All righty. Well, that was amazing, and I feel super enlightened and way smarter. What about you, Jill?
I know, I do as well. I couldn't answer any of those questions prior to this, so that's wonderful.
That was great. Well, thank you all for being with us today. Jill and I are going to go ahead and tell you about a few events we've got coming up in our community. The first one actually is our next virtual event, and that is going to be with Miss Danielle Mulvey, and she is with Profit First Nation. She is a podcaster, a speaker, a coach, and she is going to be teaching our Small Business Success Series. So that's on May 26th, right, Jill?
Yeah, 3 p.m., May 26th. And I think we have the link here. Let me see if I can pull that up and share that with you. We'll put it in the comments after this as well. But yeah, I think she's going to be great. You actually said you listened to one of her podcasts last night.
I listened to one of her podcasts. She's excellent. She sounds like she's got it going on, and she has turned, what is it? 50 million plus in revenue each year for all of her businesses that she helps. I mean, she gave so many examples of businesses she has just helped turn around. So we're really excited for that. And I just think it's an excellent time. If you are a small business owner, especially if you are starting out in small business, you want to get this right off the bat. And I believe that Danielle Mulvey knows what she's talking about. So we encourage you to register for that, because you can get the book from us, correct?
That's right. The first, however, 20 people to register receive ebook, a digital copy of the book. Get on that website. We just posted it. Get on there, register, and we will send you a copy of that book. That way you can be prepared when she speaks this week.
Absolutely. Let's see, what else do we have coming up?
One thing that's really fun is Grad Spree. Grad Spree in Marion is coming up this Thursday, actually. Thursday night, Ashley and I will be at the Hub for Grad Spree.
Up all night with those high schoolers, and we are so excited because we're going to be serving Crown Brew coffee.
Ooh, cold brew, Crown Brew.
Oh, yes. That is going to be fun. So if you are a Wildcat parent, tell your kids we're going to be there. And if they have any questions about Farmer State Bank, we are so excited and happy to answer those questions for them because they are starting to grow up. And it's going to be
last day of school. Exciting.
Yes. The next thing that we have coming up is the 2-person mixed scramble at Lake of Egypt, right?
Yep. Lake of Egypt Country Club.
Country Club. Yeah. And that is on June 6th. And there are 2 shotgun starts. One's at 8 o'clock and one is at 1 o'clock. So, Jill, do you have anything else to say about that? Golf?
It's going to be a fun day. I think there's going to be a food truck there to serve you lunch. Lunch is on us. We're partnering with Little Tractor for that event, so we're both sponsors at that golf tournament. And it's a 2-person scramble. So find your buddy, your golf buddy, and get registered for that. You can call Lake of Egypt Country Club and register. So.
Yes. And then one last thing, we are hiring at Farmer State Bank.
We are
hiring full-time teller, part-time teller, and some first-time account openings.
Yes.
So if you would like a job at Farmer State Bank, you can certainly apply with us. We have posted them on our Facebook.
Yes, and it's on our website as well
at myfsb.com. So
absolutely, and with those full-time positions comes great benefits and also banker's hours. So I mean, what could go wrong, right?
And a great staff, a great place to work. So
all right. Well, thank you all for joining us. And that is it for our Mortgage 101. And we will see you next month for another topic on mortgage loans. Thank you.
Thank you.